Good morning, everyone. I would like really to thank the World Bank Treasury for inviting me to this panel. And the reason I'm going to say is that this forum became really one of the main events on sovereign debt management, and for years. Huh? So yesterday I was just talking to some friends outside in the reception, remembering 20 years ago, like on what I believe was the second debt management forum, that I was still like studying in the US and then working also in the Brazilian debt management office at the time. So it's really a true pleasure to be here. This is really a highly valued event, and then with a very established reputation. The topic that we have today, we're talking about domestic bond market, is not really new. I was actually in the previous event here in a similar session. But why the relevance? And then we're having a plenary session on a topic of that. We have all seen in the beginning of the decade of the first decade of 2000s, how there was a significant change in the portfolio, like what we called, I remember a paper with Antonio that we called the portfolio transformation in debt towards more local currency debt. And since then we have been monitoring this, and we know that for the last 5-6 years it has been around 85%, 87%, etc. But as Rodrigo was mentioning, and we heard in the previous session, there are a lot of uncertainties around in the international environment, about interest rates, capital flows. Some are more positive, others are negative about QE, and the impacts that will happen. And then also on the work we are doing, we are observing the countries, several countries facing fiscal challenges, as we've been hearing in this forum. But when we go deeper into domestic bond markets, we see also a lot of changes taking place under this environment of uncertainty internationally, and under this environment of fiscal space not being so much there, and then the challenges for many countries. And what are those things happening? We see changes in investor base, both domestically and then the international participations, as we're going to hear some of the panelists mention. Market infrastructure, for example, a lot of countries looking into this question and already taking action on linking to international CSDs like Euroclear. And then we have all the regulatory changes that happened since the crisis, now putting the banks in a different position, like primary dealers, like market making being much more challenging, and we are always working on, should we have a primary dealer systems, what changes should we make? We are seeing that how this is becoming really, really like in the top of the agenda of many, many countries. So under this context of so many changes, like I'm very happy to have here the panelists where we have a mix. We have José, because we're from Brazil. José Franco, that leads the debt management office in Brazil, Undersecretary of Treasury. We have Rita, Granger, that I had the pleasure to, when I was working in Brazil, to go and visit and be hosted by Rita in the Portuguese debt management office, IGCP, and Rita, we're very glad to reconnect and have you here. So very experienced, very important markets and very experienced panelists, and we are very happy to have Carlos too from Goldman Sachs to give that angle of the buy side on how they are perceiving the policies that are being implemented, what are the challenges. So in that context, I would like to start, what we're going to have is a panel and then a free discussion and rounds of questions and open for general questions. The first question that I asked them to reflect on, and then we're going to start with the debt managers, is if you could share, just to set the stage, give us an overview of the characteristics of your domestic market, the recent trends then that you're observing, given this context in terms of liquidity, the instruments you're issuing, the investor base, etc. And how do you think that these recent global developments are possibly affecting the conditions in your market. No? Let's start in this direction so that it makes the flow easier.
Right. Good morning, everyone, and I really thank the World Bank for the invitation. It's a pleasure to be here. Okay, just before entering into debt management itself, I'd just like to write a brief overview on the macroeconomic situation in Brazil and how it is affecting debt management. Okay, well, in Brazil we have some positive aspects, you know, high level of foreign reserves, inflation is under control, you know, monetary policy is quite credible. The easing cycle came to an end, so I mean, there is room to actually increase interest rate if needed, you know. On the other hand, we have lots of challenges. We have a growth issue. You know, we had the deepest recession ever. You know, that ended last year. We had. In the previous 2 years, we had minus 7%, you know, growth in 2 years. You know, last year was plus 1%. This year it's going to be something like plus 1.5%. You know, which is, you know, too little for an emerging economy. All right, and the main issue that we have is not growth, is the fiscal situation. Okay, the current primary deficit in Brazil is around 2% of GDP. You know, in order to stabilize that GDP ratio, we need plus 2%. So I'm talking about, you know, a 4% fiscal consolidation, which is a lot, something hard to do. Okay, but it is absolutely necessary in order to assure, you know, that sustainability. You know, as one of Mr. Wheeler's slides here showed that the average GDP ratio for emerging economies is 50%. You know, in Brazil, we are heading to 77% this year, you know, and still rising. Okay, according to the baseline scenario, which is quite optimistic, it will stabilize some around 2022, you know, at above 8%. You know, that you can see, you can imagine how challenging it is for Brazil to actually stabilize that GDP ratio. Well, given all this background, now let's talk a little bit about debt management. Well, in Brazil, I guess, I mean, like many other emerging economies, you know, in the past years, I mean, we shifted from international debt to domestic debt, which proved to be, you know, a very good strategy. Nowadays, the hard currency debt is less than 5% of total debt. You know, we have quite developed capital markets in Brazil. You know, a diversified investor base and a diversified debt portfolio in terms of composition. You know, one way, an easy way to think about, you know, the composition of that in Brazil. We have basically 3 types of government securities. You know, fixed rate bonds, nominal bonds. I have linkers and floaters. Okay, and an easy way to think about is the composition just 1/3 for each one of them of the local debt. Okay. I mean, the investor base is quite diversified. Okay, the main holders are local. You know, main holders are local pension funds. You know, long-term. They have a long-term view and a buy and hold profile. The second largest type of investors are mutual funds. They are basically local as well. You know, within this class of investors, you may have the real money guys. You know, and hedge funds with a more, of course, dynamic profile, but they are all locals. You know, the third major holders are banks. You know, pension funds might have something like 25%, mutual funds 22%, and banks with something like 18%. And then it comes for investors. You know, for investors, he reached a peak of 22%. Back in 2013, maybe 2014. You know, since then, Brazil lost investment grade, and then foreigners reduced their position. You know, nowadays they account for around 12%. You know, it's there are two sides here. You know, on one hand, for investors, you know, are important. You know, because they are willing to take interest rate risk, especially in the long part of the curve. Right. On the other hand, it is a risk factor, since, well, whenever they decide to exit, you know, the exit door may be too small. So, I mean, consider it as a risk factor. So, I mean, it's not bad to have, you know, low dependency or dependence on foreign investors. Okay, but such a diversified investor base is not throughout the curve. You know, I mean, it proved to be, you know, a strength to have such a diversified investor base. You know, especially in the, you know, during this, I mean, this period with, you know, a high degree of volatility. We have, you know, I mean, Brazil has its own fiscal challenges. You know, and besides that, we still have, you know, an international outlook also challenging. You know, with the normalization of monetary policy in major economies. You know, and all the sources of noises. You know, I'm talking about Turkey, Argentina. You know, the Italian budget, China hard landing. I mean, it's quite a volatile period. You know, full of uncertainties, and for that, I mean, that management should have its strength, you know, in order to cope with this situation. And of course, I mean, the domestic market, I mean, proved to be quite strong, you know, but with one exception. You know, when I say that, you know, that there's a diversified investor base, that is true, but not for the long part of the nominal curve. You know, for that part of the curve, you need we have a high dependence degree on foreign investors. You know, they are main holders of long nominal bonds. By long-term nominal bonds, I mean 10-year bonds. Right. For Brazil, the nominal curve goes up to 10 years, and the linkers go up to 40 years. You know, and for the linkers, I mean, we have local investor base, pension funds. You know, that's quite that's a point of strength, I would say. But for the nominal curve and this high dependence on foreign investors, I mean, we had a few problems. You know, in the past month, especially in June, you know, when there was a high degree of uncertainty in the international scenario, with high degree of uncertainty in Brazil. I mean, on the top of that, we still have elections in Brazil this year. You know, that, you know, will be this Sunday. So, I mean, there was a huge market sell-off, you know, market itself wasn't enough to stabilize. Then the Treasury had to step in, you know, and to repurchase, to do a series of repurchase auctions in the long part of the nominal curve, you know. And after that, the market stabilized at some point. And well, as a result, I mean, it's good to have, you know, this strength for that management. But you also have to be aware of your weaknesses, you know, and be prepared to act if necessary.
Thank you very much, Franco. I think it's very impressive the impact that the rating had in the participation of the foreign investor. But in this discussion here, it would be nice that we come back in the second question, also in these measures of because part of the topic here is resilience. Yeah. No? And then not all countries have the domestic investor base there to count on. No? And then, but how the debt office is acting when there's volatility. So you mentioned these buybacks. So it'd be very interesting to come back. So Rita, with all this experience, having worked in front office, middle office, being there in Portugal with all the different changes, could you provide us a background and light on Portugal's debt, please?
Do I have to? No. Okay. Well, front office, middle office. We are in a different place than we were when we worked together. Portugal, as you know, we are a member of the euro area. Our domestic market is the euro area market. We are currently doing okay. The economy is doing okay. We have almost a balanced deficit nowadays. However, we do have a debt of 245 billion euros, which is like 120% of GDP. Our funding needs are around 25 billion, which means they're quite big for Portugal, but they're not big enough to diversify in terms of instruments. So basically, our strategy is similar to most other euro area countries, namely it's small ones. We issue retail debt, which might be a specific thing in Portugal, the retail debt targeted instruments, and then we issue treasury bills and treasury bonds. As most of you know, we had a sudden stop episode in 2011 in the financial crisis. We lost access to the financing market. And so you talk about recent developments. I never know if recent is 4 years, 1 year, or 20. But in our case, we're still working on the aftershocks of the financial crisis and losing access to the market and all the strategy and the work that we had to do to regain access to the market. So when you talk middle office, front office, well, they're there, but we're all working in order to make sure that we can manage debt again and that we have full access to the markets. Only recently, like a few months ago, we were last upgraded by Moody's investment grade. So this has been quite long. We exited the assistance program in 2014, so it has been quite a long period. I think it would be interesting maybe to talk a little bit about how we regain access to the market and what we learned. Before the crisis, we had like 80% of our debt in foreign investors. Of course, like you were saying, when there's a crisis, those are the first to go away. And as also you said, the exit door is not really big. So what we've been doing so far is try to regain access to the market, to the investors, make sure that we have a solid base of domestic investors is fundamental. In our case, was fundamental. When all the foreign investors exited our market, it was our banks that supported the market, our retail also. So now we are more aware of that, and we try to maintain at least a third of our debt in whichever form, retail or tradable debt, in the hands of local investors, because it was really important. Namely, we were able, even during the crisis, to maintain the Treasury bill program, but we had no access to Treasury bonds. So what we've done to go back to the market, first we had to have a story. We heard yesterday from Chile, from Uruguay, Slovenia, also very interesting presentations on if you want to sell your debt, you have to sell something. You don't sell the paper. There was a time in our good times when we said that the debt was like soap. It was just a matter of the smell and the packaging. It's not. You need to have story. Yeah, different times. You need a story. You need a convincing stories. Investors are educated nowadays, so you need to have a story that tells where the risks are controlled, what is your growth scenario, what are your growth engines, how is your public finances, of course. Then we were not investment grade, of course, after the crisis. We needed to find the right, again, very important, you need to find the right investors for your current market conditions. It's worthless to be talking to 100 central banks that only invest investment grade when you're not investment grade, right? At the beginning, we were after the crisis, we were basically trading on recovery rates. So for us, it was important to reach to the hedge funds. At that stage, hedge funds were important. First, the US hedge funds, then also Nordic hedge funds, but they were important. They entered the market, volatility was high, they knew what they were doing, so it's not like, you had normal investors losing money. They knew what they were doing. After that stage, you need to prepare the second stage. When volatility goes down, the hedge funds are going to exit. So you need to get ready for the second round of investors. At that stage, we were trading like high yielders, in fact. We're talking 2013, 14. The spread was like 300 to Germany. So you need to find the kind of funds that can buy high yield that are used, like funds invested in Latin American countries. So they are used to that type of markets. And you have to talk to them, explain the story, be very transparent, have documented information on the economy, the financial state of the country. So you need to have a story for those type of investors. And then spreads narrow, and they are going to exit because they're no longer interested, you're no longer a high yielder. So you need to prepare your market for the new round, which I hope is the last round of investors. Investors more used to govies, government market, European markets, and so on. So during these last 4 years, one thing that we've done very intensively is marketing of our debt in different type of investors. And the disclosure of information, I think it's really important. You do that a lot. You have a lot of information in Brazil. We also do that. If you go to our website, we have the investor presentation. Whilst before our presentation to investors was about debt management, now it's not anymore. It's really about the country. We're selling the country, so we have very detailed. We make sure that we also send emails to the investors with the update events in the country, and good and bad news. They are sure and they rely on us to give them the bad news when they occur and did not know, from other sources. So this has been a very long process. We've also done changes in our market as it became a more risky market, more volatile. We've changed so that for the participants, it would be more interesting to participate. What we've done, we changed the auctions from multi-price to single price for the bonds. We didn't do that for the T-bills. It was not considered necessary. Another thing that investors appreciated was in terms of, instead of auctioning just a line in the auctions, we tapped 2 lines so they could choose a shorter maturity or a longer maturity. Also nowadays, every week we ask participants what they want, because they don't have warehouse capabilities anymore. It's harder to sell bonds. So rather than offer something market's not looking for, we make sure we know where their positions are and where their interest is. We also have done some changes in terms of incentives for primary dealers. We have a group of 18 primary dealers, not very different from most of our European countries, at least. They have obligations and they have some rights. In terms of rights, they have access to a non-competitive bid. They also have participation in the syndicates. So it's been a way.
Thank you very much. Because we're going to go back in the second round with questions on a question on actual policies that you're doing and go deeper. You mentioned so many issues, and I think that of interest, you're regaining access now, and there are many countries that are here gaining access for the first time, or making a lot of reforms, like institutional, or have a investor relations office and improving the quality of information. But I found also the other point extremely interesting, and I know that Hungary is here too, is the importance of the retail investors that in Portugal. I know that in Hungary was very important as well. Maybe we can come back to that. No? Carlos, from the private sector, as a trader, no? And looking at these markets, what are you observing? What have been the main changes? How are you observing this process of domestic?
Absolutely. Can everybody hear me okay? how do I connect this thing? How do I put them? Oh, there you are. I mean, the change here has been, and I want to reemphasize how important this part of this specific presentation is. The change here has been quite, and I'm going to take a more global view on this business. Basically, 18 years ago, there was no foreign holdings of emerging market debt. I actually, personal experience, I remember there was two people, myself and a Brazilian guy, trading that, and we were the two guys with a strange accent sitting in a corner. Now, we are one of the biggest divisions of, and same applies to our clients. The foreign holdings of emerging market debts have moved from basically close to nothing, 5%, to 30%. And that in the last 15 years. And it's not just the movement, it's how the progression has happened and what is going to happen next. The first few years until 2008, it was just a normal progression of economic growth, GDP growth. Markets were starting to open to the idea of emerging market debt. Then in 2008, something interesting happened. Obviously, there was a drop. Everything dropped in 2008. But the drop was not as significant. The local markets were quite resilient in general. So then what you see immediately after is explosive growth, amazing growth in participation from foreign investors for many reasons. First of all, people start understanding it's a very good way to diversify the assets. Secondly, there was commodity boom, there was GDP growth, spectacular growth in most of our markets. And thirdly, and this is something we cannot forget, the combination of demographics, quantitative easing, movement into asset managers created a wall of money. The wall of money needed to be diversified, and emerging market became one of the main assets for that diversification. Now, in terms of domestic market, we cannot forget, and I found these numbers to be quite astonishing. 80% of all new issue debt by emerging market countries is in domestic markets, which means 66%, excluding India and China, 66% of all foreign holdings of debt is in domestic markets. Again, we cannot ignore these markets anymore. Now, one thing I will mention, if you notice over the last 5 years, we have reached a plateau. We are not growing anymore. There's many factors for that. Some of them I'm concerned, some of them are less concerned. Liquidity is one, and we'll discuss that a little bit later. Fiscal is another one. And this is the time where the fiscal is going to really matter. And there's another clear one. China and India are still not present in that graph. When they start becoming more present, you continue seeing that growth. This applies to several countries in Africa. So I'm still positive that number will continue increasing. Now, when we move to the type of investors that are investing in this asset class, and I'm using Mexico. Actually, I will use a lot Mexico and Brazil as examples because they are more developed market here, and because in general I think they have done a great job. The composition has changed dramatically, and maintaining the balance of the different investors is going to be key. And you will see that in the different crises. You see at the purple line is foreign investors holding. That has grown a lot. But that growth has been done in a very balanced way, in that the pension funds in Mexico, they're still a very significant part of the market. The banks have decreased the participation, but they're still relevant. And other investment funds are still kind of still holding 1/3 to 1/4 of the market. As Mr. Moreiras was mentioning, in Brazil it's even more balanced, in that you have 25% the pension funds, 20% the hedge funds, 20% the banks, and 10% the foreign investors. That balance is going to be very important, because when you have when the market trends to be too big in one type of investor, those investors tend to move at the same time, and it creates significant liquidity problems, which is, by the way, we're going to see when we talk about debt composition. The debt composition has changed a lot as well. Before, this is Brazil, by the way. Before, we used to be very focused on floating instruments. Now, there has been a big increase in inflation linkers and in fixed instruments. That has been great because it caters to different type of appetite and investor type. The negative here, though, And that's something that in the future, when you develop this type of instrument, you have to be careful about. You may create a situation in which one asset class goes to one type of investor, and for example, in Brazil, the fixed instruments are mainly held by foreigners and banks, while the inflation linkers are very much a pension fund business. When that has happened, the liquidity in the inflation linkers, same as UDIs in Mexico, has decreased because of the nature of that investor base. So when you diversify the type of instruments you use, make sure it comes together with an increase in liquidity. And I think in general, this evolution has been very good for everybody, in that for public finances, it has given you a diversified source of investors. It has bridged that big gap between liabilities in dollars and assets in local currency, which gives you much more stability and balance. So, and for my investors, has been great because it allows them to participate in the economic growth of countries that otherwise they would not have been able to. If anything, it's very rare I have the feedback of somebody telling me, I wish I had less local currency debt. Most of the time, the feedback I get, particularly from new investors, is I wish it was easier to enter into local markets. Of course.
Thank you very much, Carlos, for this. And then I wanted to have a second round of questions, but now to ask you, like, really on what are the key policies that you think that are very relevant for boosting liquidity, supporting liquidity, let's say, and having resilience in these markets, no? And you started mentioning a few, and here there is actually some trade-offs to take, because you mentioned, Rita, the importance of retail investors, and then you have liquidity on the other side, no? And then, Franco, we know that Brazil has been traditionally very active in when there is volatility, especially because of this dependence on the long end of foreign investors, no? Which is very normal in many countries. And I have brought here, but just to make it even more like get the discussion broader, because we're talking here about Brazil and with a large market, substantial investor base, Portugal also with very specific characteristics, but we have here a wide range of countries facing different challenges. So I wanted to also bring to the attention, like just very quickly, frame this question, not only about Brazil and Portugal, but look at what lessons could you bring, like more generally. No? Like, for example, what we see in local currency bond markets, and these are charts that come from an annual publication that we do together with the fund for the G20, that we follow on how local currency bond markets are growing. No? And then this is an update that we see that local currency bond markets, they continue to grow, but they are very concentrated, especially when you look at volumes, no? Size. No? And then you have Asian Pacific being very predominant, no? Latin America second, and then emerging Europe there, and then you have Africa and Middle East. No? And then when you go inside each region, there is also concentration. No? When you, like you were mentioning a lot of times, Carlos, without China, without India, no? Like within Asia, you see how much China represents there, close to 70%. And then within Latin America, how much Brazil represents. Within emerging Europe, Russia. No? And then if we were to add South Africa here, for example, we would have with these four countries 67% of all like a local currency emerging market debt being issued. No? But the point is not only the size. No? What I wanted to bring also is that the smaller economies, like, because this can be deceiving to only look at the volumes, because they are also linked to the size of the economies, etc. But when you go to smaller economies, that's a huge process taking place. No? We know that this is about sub-Saharan Africa, no? Both domestic, the first chart shows that both on top left shows that both domestic external debt is growing, no? But when you go into the domestic market, more and more issuance of bonds are taking place in these countries. No? We see in the chart in the bottom left here that in terms of, if you see the blue line and the red line, there is still challenges. Average maturity is growing, but there is significant challenges still to grow the maturity. Now, and there is very substantial growth in the other chart. On the right, you see that the stock of domestic debt by country is growing in several countries in sub-Saharan Africa. No? So I wanted, and the other point also to bring here to the question was that there is also a rising interest, and we, again, no, because it's a process that we remember in 2005 when Brazil issued a Eurobond in reais, no? But there is more and more news coming out about local currency issuance offshore, no? And then so that's another, and smaller economies are looking into that as well. Like here we have also the Komodo bond and bottom, like which is not really, like it's from Indonesia, it's not really a small economy, but you see that there is this access of both smaller economies and larger economies to the local currency Eurobonds. So in this context, Franco, with your experience in Brazil, the policies that matter, could you bring like these two angles, like in Brazil, and then internationally, like what would you tell the audience that are good policies to boost resilience and liquidity?
Good, good. Of course, I mean, local currency bonds, I mean, are important because, I mean, the issuer does not face, you know, FX risk. You know, you transfer the FX risk for the bondholder. Okay, it's a good thing from a debt management standpoint, to transfer the risk. Okay, but in order to actually be able to sell local currency bonds, I mean, first of all, I mean, the buyer, that usually is a foreigner, you know, especially if local market is not so developed. I mean, the investors should be educated about the credit, you know, and during this process, I mean, one good strategy. I mean, if you want to sell a local currency bond, you have a few alternatives. First, I mean, you could just issue a local bond in your own market. Okay, but sometimes it's hard to be done, especially, I mean, if you have never done that before, focusing on international investors. You know, a second alternative would be to issue a global local currency bond. You know, investors, I mean, whenever investors measure the risks, I mean, we are talking about credit risk, of course, you know, any kind of macroeconomic risks, you know, convertibility risk. I mean, whenever they have to actually put the money inside the country, you know, then they are starting facing convertibility risk, you know, and some legislation risk. You know, the main difference between a local bond and a global local currency bond is that the local bonds, of course, I mean, is based on local law, while a global local currency bond is based on usually New York law or, you know, a law from another. From a major country, you know, it's, that they are used to. So another aspect is about the clearing system. You know, I mean, we could, even if you issue a local bond with local law, it could use only, you know, the local clearing system, or it could also be linked to the international clearing system, mainly Euroclear. So this is another aspect that could, you know, facilitate, you know, and be as an incentive for investors to actually buy this local currency bond. So I would say that, I mean, the low-hanging fruit, let's say, is just to issue a global local currency bond, you know, with international law, you know, and international clearing system. So I mean, for investors are used to this, you know, and that they are not going to put an extra premium because of those risks that they are not actually facing. Okay, so this is the strategy that we used in Brazil, you know, back in 2005, maybe 2005, you know, so the first 10-year fixed rate bonds was a global local currency bond, you know. I remember that my boss at that time said that he wouldn't buy the bond. Yeah. and it was quite successful, you know, oversubscribed. It was just the first step. You know, afterwards, I mean, we started actually issuing long-term local currency bonds inside the country, you know, and this the strategy of educating investors about the credit and then about the market, the local market itself. You know, it's good to actually bring them inside the country, because once they are inside the country, they can be able to play other products as well. You know, equities and derivatives and so on, and they all actually contribute to develop the local capital market. It's very important. You know, so there are those main, I mean, those two types of bonds, and of course, I mean, if you want to go further, I mean, the third step towards, you know, increasing your investor base is actually having local bonds, but you know, linked to international clearing systems, you know, which is the case of Mexico, for instance. You know, this is, I mean, consider the case of Brazil. In the case of Mexico, Brazil still use local clearing systems, you know, while Mexico has already opened up and used international clearing systems. I mean, of course, I mean, by using international clearing systems, you are supposed to reach a broader audience, broader investor base. That's why one of the reasons why, I mean, the foreign participation of investors in local bonds in Mexico is much higher than in Brazil. But then, well, those are basically the main types of bonds. And of course, I mean, we have to care about liquidity and so on, but I guess we can talk about that later.
Thank you very much, Rita. What measures would you highlight in policies that were useful to Portugal and also in terms of guidance to the other countries?
I think I agree with everything that José said. Actually, when we started building our market, we went through all those processes. I couldn't stress enough the importance of the operational part, the clearing systems, José mentioned, the link to the external systems, Euroclear, whatever, standard ones. Depending on the side of the market, of course, Brazil is a big market, but if we're talking about small economies, the investors are not going to want to invest in them if they're very different. You know, you need to be standard. In our case, a small economy at the time, it was important that we did things as our peers did. The investors don't like surprises. I actually have an episode where in one of these meetings between investors and the debt managers, like 100 years ago, and he was really mad at Portugal, and he said, I will never more buy Portuguese debt. And why was that? Because they had imposed a fee on him when he was paid his coupon. He said, I don't pay any fees on any other country. I don't know what's this. Is this real? You have to pay attention to those kind of details. At the time, our registry enterprise entity, they had fees on the payment of coupons and payments of capital. And the investors were not used to it. And it created quite a lot of noise that was at this stage unwanted. So we went back, we had to negotiate with the clearinghouse, we increased our fees and eliminated those fees on the investors. What I'm saying is standardization is extremely important. I would, however, go a step behind and say there's two different things, right? You have the local currency domestic market, and you have the local currency market. I imagine the first choice you need to make is whether you want in the early stages of your market foreign investors. It's not always a good thing, depends on the size of the market, depends on the size of the development of the economy. When we started developing at the time, Scudo market, it was not euro yet, we still had capital controls, so the market was developed exclusively as a local domestic market. It was only afterwards that we started opening the market, doing global bonds, standardization. So I think there's a choice first. It's easier for a small economy to develop the market if you're still only with the locals. I would imagine. So I would be careful. The other thing that we could talk about that's also important, that I think Carlos mentioned, is the fiscal aspect. Again, if you have a fiscal system on your government bonds that is very different from the normal, investors are going to shy away from it. So I would be careful because when you talk to the tax authorities, you know, no exceptions. They want to tax everything. So even if you see it's for a greater good, the externalities of domestic debt and so on, they don't see it. So you need a political pressure to make sure that your fiscal system is in line with your peers, the ones that are competing for the funds. I think that's about it.
Thank you very much, Rita. I think that the issue of standardization is a very important point indeed, no? And also not fragmenting the debt too much if you want to reach some critical mass, no? There. But also, like this point on the foreign investor and the sequencing, it's very important. And what we usually say is like one size does not fit all at all in this point, no? That you need to be very, very careful on like the recipes that everybody is looking for. It should have a diversified base, no? But we know that it's much, much harder when you try to implement that.
Just to add another comment, of course, I mean, considering those three types of local currency bonds, you know, of course, the more risk you transfer to the investor, you know, the more expensive it's going to be for you. You know, so I mean, if you issue a global bond, global local currency, it's going to be cheaper for you than if you actually issue it locally because of the convertibility risk or anything like this.
Yeah, and then we can discuss the issues on how this can fragment the issuance if you don't have enough. Are you going to be issuing two markets instead of only one? No, and then there will be questions like, Carlos, por favor, please.
I have a solution for that. Make your currency convertible. That's aside. To answer your overall question, let me clarify my role. I have a trading desk, so at any single point of time, my inventory of new bonds is relatively limited, so I'm quite irrelevant. However, I do talk, my clients are the people who actually matter to you. I talk to the real money, to the hedge funds and so on, the people who actually own your debt. And what I have done for this panel is I have gone and asked them, all of them, what matters to them. So I came back with a shopping list. A quite comprehensive shopping list of things that matter to our investors. And by the way, I sorted as well in terms of importance. So the order is as important as the points. The number one, and has been for everybody, the point that everybody is making, is strong fiscal dynamics. I mean, people are very concerned about that, and I think this is what is going to differentiate our markets next year. And people are actually getting very smart about the fiscal dynamics. It's not just the commitment to a low debt to GDP, commitment to fiscal stability. It's the structural portion of the fiscal. I mean, most countries actually want to do, I believe all countries want to do the right thing for investors and for the population. However, when your fiscal system is very rigid, when you have too many, discretionary spending is limited, you have too much rigidity in your system, a bad economic cycle can turn around your fiscal situation. So people are looking not so much at the current debt dynamics, but as well as how much can you react to that one. And the punishment for not getting it right is quite severe. Again, as we mentioned before, in Brazil with the downgrade, we moved from 22% to 12% in the period of 3 years. So that's something that I know is not easy, but is in the top of mind for investors. The second one is a stable currency regime. This is exactly what we mentioned. Convertibility risk, are you going to be able, capital controls, are you going to get able to get your money out if things turn nasty, is something that definitely is a concern. The specific taxations, we mentioned that as well, specific taxations on your bonds. Important, not so much the level, obviously the level is important if you are competing with people without withholding tax and you have 14% withholding tax as a problem, but the stability of that. Governments that have taxes that go up and down, de facto becoming a convertibility measure, are those who have to pay more for the debt. And we have seen it, and we know how punishing can that be. One that is going to surprise a lot of the audience, very important for international investors, how strong and independent the pension and insurance business is. And this is tremendously important because our investors need to see this another side. There's a professional, independent asset management industry in the countries that they invest in. A huge difference between performing countries and less performing countries. Electronic platforms. We always talk about electronic platforms, and I don't think we see how important it is, not just because they provide liquidity, but more importantly, they provide transparency. Price verification, price transparency is almost as important to investors as the liquidity in itself. One thing that is becoming more important, and I'm going to give you one good example and one bad example, constant communication between the Treasury and the government and the investors. One bad example, and I'm not going to say the country in order to not offend anybody. Recently, let's say in the last 2 years, a country gets into significant trouble, investors are suffering, and instead of trying to take a pause in the debt capital market, they decided to issue because they thought it was the last chance to issue. Bonds drop 7%, investors get unhappy. In the period of the next year, foreign participation drops significantly. One good example, not because Mr. Moraes is here, a few months ago, there was a moment of really bad liquidity in the Brazil nominal market, where some hedge funds and some international investors, in particular part of the curve, were finding very difficult to exit the positions due to a very squeezed liquidity. Then what they did very successful reverse repos that managed to stabilize the market. That type of thing is what matters to investors at the end. They know that eventually things get ugly. They can talk to somebody. They may not get the answer they want, but there will be somebody there listening to them. And then the last one, and that one benefits me too, the figure of market maker. Not because it's good for me, but because it's good for the market. In situations of low liquidity, I find that sometimes the market maker is the only one willing to provide prices. Incentivizing and helping the market maker makes a very, very big difference. And it can be like small things, like better access to securities lending window or green shoe. Just little things, but you need a market maker. Most of the time you don't need a market maker. When things turn nasty, you absolutely need a market maker.
Thank you very much, Carlos. I think this is extremely useful, the work that you did, like trying to collect this list, the shopping list. And then it brought us back to very two sets of measures, because there are some that are more enabling environment measures that sometimes many of us here, we have no control as debt managers on how the fiscal situation is and et cetera. But we know that how relevant they are in how we set our strategy and then how we implement it, no? The issues of convertibility. But I think that a lot of the topics that are very core of our day-to-day, and then we can say on advisory that we do in many countries, are these challenges of electronic platforms, how you can incentivize market makers to actually be quoting prices. And I completely agree with you with the point you made that it's not only about the liquidity and how much trade you get, but it's about transparency of prices, et cetera, no? So I would like to spend the last 20 minutes that we have, that we were squeezed in the time we had. But that is fine. And then I would like to open for questions, no? So that we can take advantage of the panelists that are here to answer the questions that the audience has. So we have a question back there.
Yeah, thank you. Very interesting presentation. I wondered if the panelists could comment on global depository notes, whether they think that has any role to play for making local markets more accessible. I think a few countries have done that. I haven't seen a lot of it. But maybe it's an alternative to the global local bonds.
I can give you my perception. You know, we have never done this. I know that other countries, Peru did. I don't know if Olivares is here, but maybe he might be a comment. But anyway, my concern about GDN is market fragmentation. You know, and fragmenting liquidity. You know, a GDN is a local currency bonds that can be turned into, you know, another a bond deposited internationally. You know, we can make an analogy with equities, which is quite usual. You know, it's a good way, you know, to access international markets. You know, but I have this concern about the liquidity fragmentation. You know, especially when you start issuing local currency bonds, I mean, liquidity is expected to be not great. You know, and if you actually fragment it into two different markets, there might be some issues. This is one concern I have, but I mean, probably I don't know if someone on the floor wants to comment on this as well. I don't know.
Actually, I can comment as well. I'm not very much in agreement with what you mentioned. I think they are good instruments, but they are not the final, the final objective. In that, it's an intermediary instrument with fragmented liquidity in small countries. But again, they have a lot of inefficiencies, and so. Actually, you mentioned Peru and Chile. They actually advanced from that one to a very smart system of issuing both locally and through Euroclear. But my point being, if you need to start testing the market, it's not a bad way to do it, but you don't want to stop there. You want to go the next level, in my very humble opinion.
If I may just complement a few angles here, because there is also in the question a point of the trade-off between these and the international, like the Eurobond in local currencies, right? And then I think that both actually would be fragmenting the market, no? Because and then the question that we raise here, I actually brought this point in my slide of local currency Eurobonds more as like provoking here the situation, because what are the situations that would actually be useful to issue or not? No? And then in the case of Brazil in 2005 was when the local market was only up to 4 years, and we were able to do the first issuance ever of 10 years nominal bond out, and then that helped the process of domestic market development. No? Colombia had a different story that was to issue offshore and reduce the duration mismatches that banks were having by having long duration positions in the domestic market. So you'd issue long, and then now you see new countries, even Georgia, no, that you would say like a small market that is not like it's developing the domestic market, being able to issue and attract foreign investors through a local currency issuance. Or you have, like even on the non-government side, Indonesia, like on the infrastructure sector, issuing a 3-year bond in local currency there. No? So there is this angle of access to a new investor base or some cross-fertilization synergies that you could have by having this issue. No? So that was another angle to just complement here. Any other question for the panel? Questions? You have one, Leandro? No? Okay.
You mentioned that the Eurobond local currency issuance could be like a temporary step, not like the final, like we would like to have the domestic market. And Franco brought one very interesting point, that when you're bringing the investors to the country, you can develop the whole capital market as like the derivatives, the equities, and all these stuffs. I would like to know your views on the Euroclear. Do you see it's like as a temporary or like just one step to have the domestic market being developed, or you see like that could be a final issue? Because we have some discussions on fragmenting the market on not only on the GDN and the Eurobond local currency market, but also for the Euroclear bonds. Like we had some concerns in some countries to, if there is an Euroclear, maybe the foreign investor will not come for the domestic market itself, and then it could be one obstacle to develop the local currency market. So my question is like, do you see it as a temporary stage, or you can see that like a final, an objective. That could be, for some countries, that could be the final stage of developing the local currency market.
Absolutely, and that's a fascinating topic in that, and we have seen it recently in, again, in Chile and Peru. The thing I found about Euroclear is it complements the local market, in that I like very much when they do a double issuance, both Euroclearable and in local market, because what happens is the investor base for emerging market has grown a lot, both in size and the number of investors. We have people who never considered emerging market before, and now they have teams specialized in that one. The problem that they have in some of the local issuances is setting up the account, setting up like a local presence is actually very complicated. So the international investors that typically invest in local are big ones who have been doing it for many years. The Euroclear caters to a different type of investor, are the newcomers. The newcomers that want to do local currency, but they cannot due to, or they want to do like specific domestic issuances, but they cannot because they cannot set up the pipes. And that's great, because as they grow, they will move more to the local side. So I don't think there's cannibalization between both. If anything, I think they complement each other pretty well, as we have seen again in the recent examples.
I think in our case, well, it was a long time ago, but we started developing the market using Euroclear. So we moved out of domestic market when we started having more government bond auctions. And it was really helpful. It really worked. Spreads were quite narrow. The market opened up. The foreign investors came to the market. And then when the market was more mature, also the euro helped, I have to say again, a particular condition, but then we went back to our domestic market. But the experience of launching the negotiable, tradable government bonds in Euroclear in order to reach the non-residents was very, very helpful, very useful.
Other questions? I have one question there.
Yeah, madam, I wanted to know as to like what is the difference between the yield in the domestic market and in the Euroclear market? Means what will be the, means if I am going to issue my bonds in the domestic market and simultaneously I am opening this for the Euroclear as well. So what may be the spread between both the markets, and will the problems in the overseas markets will spill over to my domestic markets because of this?
Well, in the case of Brazil, local bonds are not Euroclearable. You know, they only use local clearing systems. Okay, while the global local currency bonds, they have two different. I mean, they do use Euroclear and New York law. So I mean, the level of risk, let's say, that investors are getting is much lower. In the case of Brazil, the spread between the local curve and the offshore curve is around 200 basis points. You know, being the international, the global bond cheaper, you know, from the standpoint of the issuer. You know, probably the difference, and the potential spread, I know, maybe it's a question that Carlos can answer, you know. If in Brazil, I mean, I make local currency bonds, local bonds actually Euroclearable. I mean, what would you translate that in basis points? I mean,
but actually, that's exactly answering the question. There is a lot of different combinations here, and it's like if you're talking Euroclear, local currency versus foreign currency, significant difference in spread because it's completely different risk. If you're talking local currency with Euroclearable, local currency without convertibility risk, yeah, the difference, there's some difference, is effectively in Brazil will be the 200 basis points, but they will not be as large as versus dollar. Now, if you're talking in a way which is in some countries are starting to do now, local currency versus Euroclearable local currency with full convertibility, the difference should not be very large. It should be tiny. It should be just a question of arbitrage of liquidity. So again, three different combinations of what kind of risk, as you mentioned before, you want to pass to the investor.
many of the developing countries, in fact, most of the countries borrow through general obligation bonds. But many of the developing countries have been irresponsible in the sense that they have not used those proceeds properly, and they have gotten themselves into debt traps. So do you see, or do you think that a move towards project-based borrowing is a better idea, especially for developing countries? Can it promote more responsible borrowing?
Well, I guess those are different products, I'll say. Okay, I mean, it's important to have, as you mentioned before, standardization, you know, in order to prevent fragmentation of throughout the curve. You know, for this aspect, I mean, having, you know, standard bonds are good. You know, it fosters liquidity and so on. Project bonds are another product. You know, those products are for specific projects. You know, with peculiarities in terms of the cash flow, and they could be amortizers or not. You know, those are different products. But I mean, then comes to the first, you know, the most relevant topic that Carlos mentioned, that is in mind of investors, which is the fiscal dynamic. I mean, if an issuer is being irresponsible, I mean, he will be penalized for that at some point in time, regardless the fact that he's issuing a standard bond or a project bond.
Absolutely. A couple of things I would say. I think it's a little bit unfair to talk about debt trap when emerging market debt to GDP as an average is 69%, with developed market debt to GDP is 130 something. But I do get your point. Some countries have not used the proceeds in the right way. Saying that, project bonds are starting to be a very interesting source of revenue if you do it right. In that. Making the investor take certain risk to the project diversifies the country risk. I mean, we have seen it in the development of the 4G infrastructure in Colombia with the private-public partnership. Argentina is doing a program on that with the PPPs. It's becoming a more prevalent way of funding. The only thing I would say for that, you need a very stable, a very clear legal framework. In that. Colombia and Peru have been doing that, and Mexico, because you can rely on the legal framework. If you don't have that, you cannot issue.
Okay, for those that know me from different trainings, different conferences, they have heard me sometimes saying that the issue with debt managers is that the blanket is too short. No, that's what I usually say. No. That when you try to cover your head, your feet is exposed. When you try to cover your feet, your head is exposed. So there are huge trade-offs in this discussion. No? And then in the past, that's actually how everything started, was a specific purpose. You want to build a bridge, you issue a bond to build that bridge. No? And then, in a way, and yesterday we had a panel on thematic bonds, which is a very new, interesting topic, no? That there are debt offices, and then and also in the private sector, there are specific, on green bonds, on things like that you're issuing for a specific purpose. But there is another angle in this discussion, which is like a bond that is and a kind of a project financing type of structure that you see, for example, in China, when you having a huge change on that one. There is an infrastructure-related investment that you can do in a project finance way, that you have the risk of the project, trying to have that with non-recourse. No? That's what you try to reach with when you reach through project finance. No? So there are these
and actually,
trade-offs.
I completely agree. And the best thing of project bonds is, and I think there's an analysis from the World Bank on that one. When you have a project financed with a private-public partnership, the cost tends to be half. In that you don't run over cost. Because it's great to have a private investor kind of keeping an eye on how you're spending the money. That, I think, even more than fiscal stability, that is what makes a huge difference.
Yeah. So the question you had is actually very broad and very hard to answer, given all these trade-offs. No? other, Joscon.
Thank you. Well, Graham, in his presentation, highlighted the importance of coordination between debt managers and the central banks. So we know in many countries, the short end of the yield curve is a bit congested. So central banks are issuing short-term securities, and also, again, the debt management offices are also active there, especially because of the Treasury bills. So also we know that the importance of the money markets, the repo transaction, all other issues, those are also directly related to the development of the government bond markets. So how do you see this coordination and how this can be improved, especially, looking at the future? We know there are some standard approach that has been going on, so there are some formal coordination between central banks and the debt offices. But what should we expect more, just in terms of the development of the government bond markets?
Well, this is an interesting issue. In most countries, there is all this a kind of friction, between the debt issuer and central banks. They have different purpose. I mean, the debt issuer, is responsible for debt management, while central banks are responsible for liquidity management. Of course, I mean, whenever they mix the purposes, it's you risk to have a fragmented yield curve with different bonds, central bank bonds and Treasury bonds. In the case of Brazil, we, after a long period of friction, we reached that kind of balance. In the case of Brazil, the central bank is not allowed to issue bonds, okay? But the central bank uses the Treasury bonds. I mean, the central bank in Brazil has an inventory of Treasury bonds, and they use those bonds as collateral in repo transactions. And that's how the main tool for managing liquidity in Brazil is through repo transactions. And in Brazil we have a structural liquidity problem. If you look at the gross debt in Brazil, 25% of this debt are the Treasury bonds inside the central bank portfolio. Okay, so but anyway, it's a fascinating subject. It is important, not to have fragmentation, not to have a more efficient yield curve.
This is a topic quite to my heart. Obviously, by the questions I put to Graham, it worries me a little bit that this quantitative easing and this intersection of functions between the central bank and debt management continues in the future. We've had, I don't know how many years we have of quantitative easing by the ECB, but we had some quite anecdotal things happening that are not very funny, namely when, like ourselves, we want to return to the market. Namely, there was a Monday we came to the market and our spreads were widening. And, there was nothing, no news, nothing. And it was a local holiday, but, it was not a target holiday. And the market was nervous because the ECB and all the central banks were buying, but Bank of Portugal was not buying our debt. So they thought there was something. Something that was happening was Central Bank of Portugal was at home in the local holiday. They don't have the... And there's been it's not just our central bank. The ECB also changed the policy of repurchase of the purchase of the bonds. They didn't warn the market, and so suddenly the amounts didn't match what was the expectation, and spreads were all over. So this impact of the monetary policy on the debt management is not easy. I'm worried that it's going to go forward, but I have to say, going maybe to your question, it's a learning process. I think the ECB is learning that they can't just technically change what they're doing without warning, And we're also learning to talk to them more often, not officially, but more often.
Any other question to the panel?
Going back to the settlement systems and Euroclear, there is a lot of buzz right now about the use of blockchain technology in capital markets. The World Bank issued a blockchain bond a few weeks ago, and I wanted to know whether this is something you are looking at as a way to attract more investors in your local markets, or as a way to overcome some limitation, restrictions of the existing settlement system.
Well, the technology itself is quite interesting, you know, and it has a huge potential. You know, in the case of Brazil, I mean, we have this specific programs called the direct Treasury, you know, only for retail investors. It represents around the 1% of the total debt. I mean, we have, you know, we are assessing the technology to implement in this specific program. You know, but not to, you know, it's not issuing bonds linked to any cryptocurrency and anything like this. But we are assessing the technology itself only for that specific program, which is our first step.
The only thing I would say, every time Goldman Sachs talks about Bitcoin, it moves 5% up or down, so I'm going to be very careful here. The only thing I would say, we are in communication with the public side to see what the thoughts on the topic. We obviously, when they are ready to issue, we hope we will be ready to trade it. It's definitely the future. I don't think it's immediate, but there's a lot of people thinking and talking about that.
Well, we started here to discuss about like a next generation of bond markets, resilience, etc. And then what we went through is to see that these markets are actually growing a lot. No, there are a lot of volatility and turbulence going on. No, it's important, but we see that the process is being diversified. More and more smaller markets are also. There's a whole phenomenon taking place that you don't see if you look only at the big numbers. No, more and more countries are issuing bonds, trying to extend maturities. No, and the challenges of attracting foreign investors, be it like in a way of Euroclear, no, or accessing internationally first and then bringing them. Now, these are all policy questions that are very high in the agenda right now. So this session was to talk about the trends. What are really the main things happening? Like there is a whole sea of change in the secondary market architecture that involves like how to set electronic platforms more effectively, how to have primary dealers systems that actually work, because like in 80% of the countries we go, we say, oh, we have a primary dealer system, and then you have complaints from the dealers and complaints from the debt managers. No? So how do you actually get something that you can make incentives? And as a big friend of several of us used to say, like about one Richard, like primary dealers is kind of a marriage, like a man and wife, but don't ask who is the man and the wife in the relationship, but you need to make it both work. No? So I would like with that tone, I think it's a more optimistic tone that things are happening. No? There are a lot of different questions and trade-offs to assess, but there has been really, truly a structural shift in issuance of domestic debt towards local currency now, and it's being like stabilized around 85% in many countries. Other countries are a bit lower, but this is something really structural, and you can see by international indices on how they are actually adding more and more countries as time goes by. No? So with that, I believe that we are close to the coffee break, right, Rodrigo? But I would like to thank a lot the panelists for the interesting.
Thank you, Anderson. Thank you to the panelists. Just before we break for coffee, a few quick notes. First, we will make all the conference materials available to you this afternoon. on USB flash drives. Before you pick up your flash drive, we really ask you to complete the evaluation form so that we can continue to improve the program. You should have all found this evaluation form in your tables or chairs when you came today. You can handle these evaluation forms to any one of the event staff who have the yellow badge, or you can just leave it on your table or on your chair that we are going to collect it. Second, like yesterday, the coffee breaks will be served outside of the breakout rooms, so we're going to go directly to the 2 breakout rooms. You have the choice of breakout session number 5 on Don't Derail, Keep Your Guarantees and Landing on Track. This will be on the 13th floor in room MC 13121, that direction. Or breakout session 8 on being active on the day after the use of liability management operations. This will be on the 2nd floor in room MC 2800, that direction. Finally, please note that after the breakout sessions, there will be a group photo in the atrium, the same place that where we had lunch yesterday and where we're going to have lunch today. So just after the breakout sessions, we'll come down to the lobby, to the atrium, have the group photo, and have lunch there. So thank you so much.